Capital FLE. Canada faces record investment flight. Canada is standing at a crossroads as Prime Minister Mark Carney's government navigates its first months in power following the snap federal election on April 28, 2025. What was once pitched as a fresh start for stability has quickly collided with an unforgiving economic reality. The story dominating headlines is clear. Investors are rushing for the exits, capital is fleeing at a historic pace, and Canadians are left wondering whether the national economy can withstand the shock. Ordinary families already facing high food and housing costs now hear that money is leaving the country faster than at any point since the financial crisis of 2008. For many, it feels less like a temporary dip and more like a warning that confidence in Canada is fading. The numbers paint a sobering picture. In the second quarter alone, net outflows of securities reached nearly $84 billion, with both foreign and domestic investors offloading Canadian holdings. Foreign ownership of Canadian stocks and bonds fell sharply, while Canadian firms moved tens of billions into U.S. markets. Even individual Canadians are redirecting savings south of the border, betting on stability while uncertainty looms at home. This level of capital flight is unprecedented in modern times and speaks to a crisis of trust. While Canada's economic fundamentals, such as relatively low government debt and strong education levels, remain intact, confidence in the country as a safe destination for investment is rapidly deteriorating. The downturn is not limited to market flows. Canada's economy shrank by 1.6% annualized in the second quarter after a weak first quarter, officially pushing the country into recessionary territory. Much of the contraction stems from trade tensions with the United States, where President Donald Trump has implemented sweeping tariffs on Canadian autos, steel, and aluminum. Exports have plunged by more than 7%, cutting directly into manufacturing jobs and threatening long-term growth. The Bank of Canada has warned that if these tensions persist, Canada's potential output could be permanently reduced, leaving scars on the economy that last well beyond the current political cycle. Prime Minister Carney has tried to move quickly, making a clear break from his predecessor's policy agenda. He revoked the consumer carbon tax, delivered targeted income tax cuts, and suspended the GST for first-time homebuyers in an attempt to ease affordability pressures. His government also dissolved retaliatory tariffs that were hurting consumers and announced a new major projects office to fast-track critical infrastructure. These moves have been welcomed by some as pragmatic, but critics argue they are stopgaps that do little to address the deeper issues of competitiveness, trade dependence, and productivity that continue to undermine growth. Despite the turbulence, not all signals are negative. Service sector spending has held up better than expected, with Canadians still frequenting restaurants, entertainment venues, and travel despite rising costs. The country also remains relatively strong compared to global peers, with the lowest net debt among G7 nations and a high ratio of foreign direct investment to GDP. These factors act as stabilizers in a stormy environment, but they have not been enough to fully offset the damage from collapsing exports and surging capital flight. Investors are watching carefully to see whether Carney's reforms can deliver more than symbolic relief. Trade tensions continue to cast a long shadow. The Bank of Canada has released projections showing two possible paths. If Trump's tariffs and barriers persist, Canada's potential output growth could grind to a halt or even turn negative by 2027. If tensions ease, growth would remain modest but positive. This stark contrast highlights just how vulnerable Canada remains to the U.S. market and why diversification into Europe and Asia is now at the top of Ottawa's agenda. Carney has already traveled to European capitals to secure closer ties on both trade and security, signaling that reducing dependence on one market is now a political priority. The political stakes for Carney are enormous. His Liberal minority government cannot afford a prolonged economic slump without risking collapse in confidence among voters. The Prime Minister entered office with high expectations, but his honeymoon period is proving to be one of the shortest in modern Canadian politics. Inflation-adjusted wages remain stagnant, unemployment is creeping upward, and housing affordability is still out of reach for many young families. Without visible progress, Carney could face the wrath of an electorate already skeptical of government promises after years of economic frustration. Still, voices of cautious optimism remain. Some economists argue that Canada is resilient enough to weather the storm if policy remains focused and trade negotiations achieve partial relief. Projections suggest that if Carney's reforms stabilize confidence, modest growth could return by year's end. Fiscal discipline and strategic investments in infrastructure could provide tailwinds in 2026, offering a chance for recovery if global conditions do not worsen further. Yet even these assessments acknowledge that the current period is one of exceptional uncertainty, with volatility likely to persist for months. At the same time, social anxiety is building. Canadians have not only moved their investments abroad, but are also questioning whether the government is prioritizing domestic issues. Online forums are filled with frustration over the focus on international diplomacy, while Canadians struggle with mortgage renewals, high grocery prices, and job insecurity. While some comments border on exaggeration, such as half-serious calls for U.S. annexation or open migration south, they reveal a deeper truth. Ordinary people feel neglected and desperate for leadership that delivers results at home. Yet Canada is not without resources or identity. The capital exodus, while severe, does not erase decades of institutional strength, resource wealth, and human capital. Carney's government has launched infrastructure fast-tracking and signaled willingness to pivot policy aggressively if necessary. The challenge lies not in Canada's capacity to rebound, but in whether its leaders can restore confidence fast enough to stem further outflows. Investors and citizens alike are watching to see whether actions match words. The choice now is clear. Either Canada confronts the structural weaknesses exposed by this crisis, over-reliance on the U.S., sluggish productivity, and affordability breakdown, or it risks allowing the current downturn to solidify into long-term decline. This requires not only political will, but also unity among provinces, industries, and citizens who may otherwise retreat into cynicism. The urgency of the moment cannot be overstated. The world is sending a message, and it is one Canada must heed. In the end, the story of capital flight is not just about numbers on a balance sheet, but about confidence, trust, and vision. Money follows stability, and stability follows leadership. If Carney can balance economic reform with diplomatic skill, Canada could yet turn a moment of crisis into a turning point. If not, the risk remains that the phrase capital flee becomes not just a headline but the defining reality of an era. Canadians are waiting, and the clock is ticking.